Well, hi everyone. Welcome to another episode of the Wise Wealth Podcast with myself, Josh Humphries, and Shaun Humphries. We got a pretty exciting agenda today. We got a great market update, an under 40 tip, which will be centered around the TFSA room increase that happened pretty recent. And then we're going to finish it off with some kind of tips surrounding retirement planning and how to best do that. So, Shaun, what do you want to start out with?
Well, a lot's been happening in the markets the last little while. So why don't we talk about the market update? So when we talk about capital markets in the economy, there's no doubt that the biggest issue that the economy has been struggling with has been interest rates. We've seen a pretty dramatic increase in rates over the last little while. And the Bank of Canada Governor Macklin messaged pretty strongly that interest rates are likely to be close, if not at the peak. And I want to share with you some of the main comments that he had made at this recent meeting where he was discussing the direction of interest rates over the next several months. So in a recent presentation, Macklin made the comment that he felt the borrowing costs may now be restrictive enough to get inflation under control. Tight monetary policy is working to cool demand in the economy. And so as a result, feels that there'll be downward pressure on inflation looking forward. Now, what was interesting is recently the annualized inflation rate dropped from 3.8% in October to 3.1% in the most recent reading. So inflationary pressures definitely are trending down towards the Bank of Canada's target rate. And so he felt also that finally, based on the most recent pronouncements by the finance minister, that both the Bank of Canada and their policy to drive down inflationary pressures through higher rates are working more in tandem with the federal government's more judicious use of the budget and trying to rein in some of the spending that's been happening over the last little while. So fiscal policy has been a little bit out of sync. Governments have been aggressively spending, and the way that we get inflationary, trends curbed is to make sure that governments are being cautious in their spending, as well as the Bank of Canada pursuing a policy that stems the tide of inflationary pressures through higher interest rates. Most private sector economists believe that the Bank of Canada has finished tightening monetary policy, and many are betting it will even start lowering interest rates by the middle of next year. Now, why this is important is if you are having a mortgage renew or you have kids that are getting a mortgage for the first time, with all the uncertainty about interest rates, people are naturally inclined to kind of just jump in and lock in a rate. You don't want to be doing that. So you want to stay short term and more of a variable rate, because in all likelihood, as we get through to the end of 2024, interest rates are going to be lower. So that's good news. And so I'm going to bridge off this discussion and talk about some things that we've referenced before a little bit, but I think it's worth connecting the dots between the Bank of Canada's policy, a little bit more of judicious spending and budget planning by the federal government, to what might happen in capital markets and in your portfolio over the next year or so. So we may have shown this chart before. This looks at the dramatic acceleration of rates through 2022. And at some point, we felt that rates would peak. It's been a long time coming, but we're finally at the point where likely rates have hit a peak. And then certainly the Bank of Canada's assessment is, I think, and the market very much believes that rates have peaked and that we may even see rates come down in 2024. Now, that's important because we've been living with an inverted yield curve. Normally when you look at interest rate policy, short-term rates are lower than long-term rates. We get compensated more the longer we lock in. But we've been living in this world where short-term rates have been higher than long-term rates. And we're finally in a point in time where likely we'll begin to see a movement back to a more normalized yield curve. And often when that happens, it creates potential price appreciation in the fixed income bond market and sometimes the stock market as well. This chart's a really interesting review of some of the major interest rate cycles over the last number of years. I'll just draw your attention to a couple of them. Back in August 22nd, 1984, we saw the Federal Reserve Board, the Fed, pause rates in August, and the pause rate was 11.75%. And within the year of that pause, U.S. investment grade bonds were up 26%, and government treasuries were up 22.3%. U.S. large cap stocks were up 32%. So we've talked about this before. On average, when you see a pause in rates and then eventually we're probably going to see a reduction in rates, the bond market or fixed income markets begin to anticipate, they look ahead and begin pricing bonds at a premium. You see a rally in the bond market to reflect the fact that interest rates will likely decline. And so this is what we've been waiting for. If we look at portfolios, it's been a tough time in fixed income investments. Now that we're at that peak, likely we're going to see potential price appreciation in the bond market. But it's not just the bond market that goes through price appreciation. Again, on average, large cap stocks, as an example, have been up 21% every time we've seen a cycle over the last number of years where central banks paused rates and then eventually declined the rates, and we saw stocks go up. Again, stocks go up because it's not the only metric, but stocks get priced against current interest rates. Obviously, if rates are going to go up, the carrying cost of debt for corporations go up. That can degrade corporate earnings. Now, stocks tend to trade as a multiple of earnings, so if earnings are going to go down, share prices go down as well. If the market believes that interest rates are going to go down, then of course you're going to see earnings and profits go up as well, potentially. And again, if stocks trade as a multiple of earnings and rates are going to go down to improve earnings, we'd see higher share prices. The market, this is the most important thing. The market never just looks at the current reality. The market's always looking at what do these policies mean for assets and the economy going out the next year or so, and then begins to price in what they think the investment should be worth based on what the future direction will be based on the market's expectations. So, Josh, that's been a really encouraging sea change over the last little while. We've been waiting for rates to get to a peak. We think we're pretty close to that, and it has important implications for both investors and borrowers as they begin to decide how they want to approach decisions in those financial areas.
I think it's a little fascinating, but I guess one could argue they've been saying this for a while, right? So what's kind of different about I don't know, like recent talks about the rates coming down versus before?
Yeah, like I think there's a number of reasons, but I think the thing that gets talked about a lot in the current context is, number one, they are seeing in the macro numbers that the annualized inflation rate is trending down. So that's been a consistent trend over the last number of months. That's the first thing. The second thing is they're beginning to see the labor market loosen up a little bit. So that means and sends a message to central banks that as the labor markets loosen up, some of that inflationary pressure will go down as well. Because labor is a pretty big component of inflationary pressure. If you look at wage costs as they go up, that is inflationary. It puts more money in circulation. There's more purchasing that can happen. The second thing is, as it relates to labor, if it gets loose and there's not as much pressure in the labor market, then salaries begin to plateau. There might be less spending in the economy, which decelerates some of the inflationary pressure. So those might be the two main forces that are driving some of these decisions right now.
Yeah, that makes sense. All right. Well, was there anything else you want to add to that, or should we move on to the under 40 tip for the?
Yeah, why don't we move to the under 40 tip? I know you've got some information for us, just hot off the presses.
Okay, so TFSA contribution room is going to be increased for 2024, so it was officially released. So the limit is now $7,000, which is up from $6,500 last year and also $6,000 in 2022. So that's the first time in, I guess, history that we've seen 2 consecutive years of increases on the annual TFSA limit. So with Thursday's TFSA limit announcement, the CRA, the total contribution room available for 2024 for someone who has never contributed and is also eligible for TFSA will be up to $9,500. So that's obviously including the 2024 room of 7,000. Pretty exciting news.
Yeah, I mean, it's a great thing. We've talked about that before on the podcast. You want to take advantage of TFSAs. A couple of things I'll mention about TFSA. So it just came up yesterday. I was talking to the client, and the client said, "Can you have more than one TFSA?" And many of you watching me already know this, but not everyone. And I said, absolutely, as long as you don't go over your lifetime limit, right, between the various TFSAs that you can have, they have in place, you're good. And the reason the client asked the question is that sometimes they'll have different TFSAs for different purposes. So you might have one TFSA with their broker or advisor that's more long-term growth orientated, and they might have a TFSA with their credit union or the bank that's more cash and GICs for more short-term expenses. So that would be one reason you might have multiple TFSAs. The other reason is you might have TFSA that has different investment mandates within the one account. And so something for you to know. So if you've got a brokerage account, if you're dealing with a wealth advisor is on a brokerage platform, we're on a platform called Asante Capital Management. We can have cash accounts, GICs, stocks, bonds, ETFs, all in one account, so that the client can actually segregate the account and say, well, listen, this money is going to be in GICs and cash. I may need to draw on it just in case. And this part of the portfolio will have is longer term growth. So all in one account, they can have different investment mandates for their planning.
Well,
So
it's
good news for sure.
That's a good segue into our next topic, which is retirement planning tips regarding guidelines for investing. So kind of like the distribution of the money in the account kind of relates perfectly to that.
Yeah.
So,
now, do you want to lead in? Do you have some questions to kind of lead into that discussion?
Well, I was thinking like the first one we cover is the 4% rule.
Yeah.
And maybe you can unpack that a little bit, and then I'll come at you with some good questions.
Okay, so this is a really important question. So we're going to talk about drawdown strategies. So for those of you that are, within 5 years of retirement or just about to go into retirement, one of the key considerations is going to be like how much can I afford to take out of my portfolio? So obviously in the context of a podcast like this, we can't cover all the different contingencies. We're going to talk very broadly about some principles to keep in mind. So one principle in terms of how much I can take out of my portfolio so I don't run out of money is the 4% rule. Sometimes it gets changed to the 3% rule, depending on how the economy is doing and what people's expectations are around investment returns. But essentially, the 4% rule has some broad assumptions. Take your portfolio value, multiply that portfolio value by 4% to come up with the percentage draw each year, whatever that number might be. And that's what your sustainable draw for your lifetime in retirement is going to be. That rough rule of thumb also, it presumes that you'll be able to inflation adjust that draw rate, right? So if I have, a portfolio that's in place and there's $100,000 in that portfolio, I can take out $4,000 a year, and then I can inflation adjust that portfolio return or income at the rate of inflation, whatever it ends up being, 3%, 5%, 2%, 6%. I can inflation adjust it every single year. It also presumes that you're running a balanced portfolio, anywhere from 40 to 50% bonds and 60 to 50% stocks in a broadly balanced portfolio. So those are the broad assumptions. It's a very blunt instrument when it comes to planning, right? So life does not work in a linear, way. Life is volatile, both personally and with markets and economies. But as a starting point for people to go, how much can I afford to take out of my account each year, inflation adjusted, without running out of money?
Yeah, it sounds like a good rule of thumb. What are some of the downsides, some of the weaknesses of this kind of blunt rule for someone, let's say, in their 50s looking to retire in the next 15, 20 years?
Yeah, there's probably a few things to consider. So first of all, again, like I said, it's presuming a certain consistency in terms of performance over time. And we're presuming that past performance of a balanced portfolio is going to be indicative of future performance in that balanced portfolio. And that's just not the case. We don't know for sure. So that's one problem. The other problem is it might encourage people to kind of set it and forget it. Oh, that rule of thumb sounds good. That's easy. 4% of my portfolio, whatever the inflation rate is each year, that's the only thing I have to keep an eye on. I can justify taking more out. If inflation's up 5, I'll increase my payments by 5. But, again, you can't set and forget your cash flow planning for retirement. That needs to be something that every year you need to really dial into and reassess whether your strategy is the appropriate one for you. The other thing is that it presumes that there's a consistent drawdown over the life of your retirement is how it actually works. And it doesn't work that way. So what we tend to find is that people will spend more money in the early phase of the retirement. It is an absolute, I'll say, lie. It's not a truth that when people retire, their discretionary spending goes down. It doesn't. So if you're healthy and you're 60, your spending for non-discretionary expenses, travel, hobbies, entertainment, those kinds of things will be there for you. In fact, you've got more time to pursue those things. So what we tend to counsel clients is build in that discretionary budget in that first 10 years likely, because you'll be more active and there's things you want to be able to do. Now, over time, you might decelerate some of that. And there's no doubt that when people get into their mid 70s, they're just spending less on those discretionary expenses. So a 4% rule is a good starting point. That's all it is. Then really what you need to do is customize your cash flows. You'll tend to spend a little more in the early years. And for many people, their expenses do plateau. There's been lots of studies confirming the fact that once people get into their early 80s, their expenses plateau. Do we really need to inflation adjust their expense needs at the same rate that we were inflation adjusting when they were in their 60s and 70s? Probably not. So it's probably clear when I answer this question that these kinds of calculations should be very customized to your scenario, and they should not be, you should not be relying on rules of thumb other than as a starting point. I've got $1 million in my portfolio. I have $500,000 in the portfolio. With my government benefits, my company pension plan, if I have one, how much can I take out of my portfolio without running out of money? Okay, it'll give you that answer potentially, but that's just a starting point.
Yeah, I think one of the attractive things about rules of thumb, right, is it gives you a sense of it makes you believe that the whole situation is kind of under your control, right?
Yeah,
so if you just tell yourself like 4% every year, it makes you feel like all the random variables that could happen, all the variability of the market, it's not going to affect you, right? Because you just stick with 4%. So I think that's one of the peace of mind is nice, right, of rules of thumb, but yeah, they definitely have a lot of pros and cons. So next, how would like timeline, this is another rule of thumb, timeline investing, and kind of what's the idea behind that, and how could that benefit someone?
Yeah, so the timeline investing is a concept that's been around for a while. Sometimes it's referred to as a three-bucket approach to investing. So let me bring up a few slides and we'll just cover it off together. Okay, we're going to look at a discussion around withdrawal strategy. So the timeline investing or the three-bucket approach ties into safe withdrawal rates, systematic withdrawal rates, and managing retirement income. So it's broadly speaking tied into that category. So when we look at our portfolios, the discussion that happens quite often is, here's the recommended investment mix for your portfolio and your retirement plan. Actually, that's not really how it should work. What it should be is mini portfolios based on timeline. So if you look at this chart, we've got, let's say a 10-year period, and we've got 3 time periods. We have this time period where it says cash, I'll come back to that. Another time period that says income balanced, and then another timeline that says growth. So here's the backstory to timeline investing. What you're trying to manage is short-term risk or volatility. Now, we can have really high-quality investments in blue-chip stocks, even high-quality, government debt bonds, U.S. Treasury bonds, Government of Canada bonds. But the reality for most of us investing is we're investing in assets that are tradable securities. So even though they can be very high quality, every moment of the day, they're being valued against other kinds of investments or against market reality or economic reality. So they may, in fact, do exactly what we want them to do in terms of return and performance over time, but we cannot predict with any certainty what's going to happen over the next 6 months or what's going to happen over the next year or 2 years, even 3 years. So how do you defend yourself against that short-term volatility? Well, that's what you do in this first part of this timeline, cash or cash equivalents. If we know we're going to need to draw money from the portfolio in retirement or for any other expense that's going to come up, you want to allocate money to this cash position. It shouldn't necessarily be a large part of your portfolio, but enough that if I need income coming out every year from my portfolio for retirement or to upgrade the car or fix the roof as part of my retirement budget, as an example, make sure you set aside GICs, T-bills, high-yield savings accounts in this category in sufficient dollars because you've done your homework to look after those expenses. You do not want to have to take money out of your portfolio when we're going through market volatility at the time that the expense is needed. So that's the first bucket. The next bucket is timelines, usually 4, 5, 6 years. That's more of a balanced portfolio mix. You might have bonds, some stocks, could be in the form of ETFs or mutual funds or individual stocks. And then growth would be pure equities. It could be private equity, infrastructure, ETFs, individual stocks. Now you're not worried about volatility nearly as much because you've got time to let those assets grow. So if about 8, 9, 10 years, this is where most of the growth of your portfolio is going to be. So as you can see, each of these buckets or timelines will have unique investment characteristics. This is not a monolithic portfolio. It's actually a portfolio made up of 3 portfolios with different mandates, different return expectations, different risk levels. Timeline investing is critical for any retirement plan that gets developed. Now, specifically, this slide talks about the income wedge. So if I go back to this slide here, there's my cash position. I'm looking after the next, let's say, 3 years of liquidity needs or income needs. Now it's that pie shape. It's a piece of the pie of your overall portfolio, a little red slice. And you can see that we're going to take money out every single year at $25,000 per year. And if there's growth in the other part of the portfolio, great. We might actually take profits from that part to fund the income. At the very least, we'll always have the income wedge in play. And when there's profits in the middle section, so I'll go back here. If I've got growth here, growth there, if you retire, do not leave that growth on the table. Take that growth, protect that growth, put it back into cash wedge, make sure it's going to be available. Although markets are up 75% of the time, they are down 25% of the time. And during that 25% of the time, you want to make sure you've got an insurance policy in place where you can draw on cash assets until the portfolio is recovered. Really, really important concepts. Now, how do we make this discussion practical? We go to the good old computer. So we want to do computer modeling. And if you watch some of our videos on our YouTube channel, we talk about projections, modeling, retirement scenarios. And that, to me, is the very best way of getting ready for retirement. And even if you're already retired, modeling what your drawdown should be, customize the cash flow needs to what your needs are, and then confirm through computer modeling, looking at returns, different inflation rates to see whether your game plan is attainable, whether you've built in some buffer to make sure that you're tracking in the right direction. So all really important concepts. You start with rules of thumb. Like you said, Joshua, good starting point, gives you the confidence, okay, I can generate X dollars of income. It's just a starting point. You want to make sure you're doing your homework. It all starts with retirement modeling. And that's what a retirement planning specialist does. There's information in the show notes for this video if you want to get more information about what we do and how this approach to retirement planning actually works.
Just to I don't know, push back, critique a little bit. So how low? So the first 2 buckets, the first bucket is short term, second bucket is a little bit longer term. How low? At what point would you start pulling from the third bucket to kind of refill those buckets, or how would that work? Or is there something you could build into the plan where you won't have to do that?
Well, it's for some people that's the case, but for many people in retirement, they're running this balancing act between trying to get above average growth on that third bucket, while at the same time looking after their income needs. And the problem is that first bucket particularly is generating returns that are not going to cope very well with taxes and inflation. So you want enough in there that it's just in case you can draw on if there's market volatility. But if you have too much there, it's going to degrade or reduce the overall return of all your assets. So you want to keep enough in there. So let's say for discussion purposes, we do the plan and we figure out that we need $40,000 a year over the next 5 years or 4 years from the portfolio. Okay, let's say there's 3 years. Well, we're going to put in place $90,000 in that income wedge. And that might be a mix of GICs or cash accounts. And what could happen at a practical level, Joshua, is that if I need income the next year and I've got some good growth in the third bucket, my growth bucket, I may in fact go into that bucket to produce the income and leave the cash wedge alone. So I'm going to harvest along the way. Okay. If the market's down in that third bucket, obviously I'm not going to do that. And in fact, I don't want to sell anything. I'm going to go back to my income wedge and take the $30,000 out of that. Now I've gone from 90,000 right to 60,000.
Mm-hmm.
Now I'm beginning to think about when am I going to replenish that bucket? Because I'm always want to have that 3 years worth of income. I might have, depending what the market's doing, I might have to wait another year, maybe another 2 years before I can go back into that third bucket. Now I've got some additional growth there. and I can shave that off and put that into my income wedge. So it's very much a year-by-year assessment as to what we're going to do with that income wedge, how large it can be, when it needs to be replenished.
In terms of asset allocation and kind of traditional asset allocation, how does that relate to this timeline approach?
Well, like I said, historically, when you talk about asset allocation, that's dealing with the mix very broadly: cash, bonds, stocks. Sometimes you put in real estate and alternative assets like private equity or infrastructure. But it's kind of this overall mix that has a certain characteristic of risk and return. And broadly speaking, when you talk about asset mix, that's what we're talking about, is trying to match the client's return objectives and the level of risk that they're prepared to take on, and then building a portfolio that's in line with that. Now, it's important we define risk. And so when we define risk, risk is variability of return, not loss of capital. It can be loss of capital if you sell a great asset at a wrong time. So I could have some blue chip stocks, let's say the banks, insurance companies, that kind of thing. Most of the time they're making money. Most of the time their share price is going up. Sometimes they're not going up. Now, if I own the bank stocks and they happen to be down right now, I'm not going to sell them. They're great companies. They're going to come back, right? So when we say risk, the risk is the bank stocks can go down once in a while, but we know they're likely going to come back. They're almost legalized monopolies. They're very profitable. They'll do well. So asset mix is that broad mix, like I said, of cash, bonds, stocks, and the mix of those ingredients needs to be customized to the client's return objectives and the level of risk that they feel comfortable taking on.
What about rebalancing? So in a situation where, let's say, one bucket does really well, let's say the stocks are up really well, at what point would you kind of rebalance that money, or how do you approach that?
Yeah, that's a great question. I mean, one of the areas that does not get attended to often, and people get in trouble because of this, is that we tend to fall in love with our best performing investments. So again, presuming you have high quality investments in your portfolio, okay, that's the first assumption. And we know that not all investments will make money all the time. Even though they're high quality, we're buying assets that are trading in the secondary market, and they can get priced in the short term. They can bounce around a little bit. So what rebalancing does, it allows us to maintain the discipline of the portfolio. If we've done homework and we've assessed that this mix from a return and risk standpoint is the right mix for you, right, in the attainment of your goals. If we do not rebalance, and because stocks are up more than bonds or cash, the portfolio, if it's never rebalanced, gets progressively more and more risky. Now, when the market's going up, many people feel okay with that. In fact, they would push back against their advisor. Why are you recommending that I sell my best performing investment and you want me to put it in that stinky cash that's only making 1.8%? Okay. And that's a conversation that advisors have to have with clients all the time. And it's natural. If this investment's up 12% this year and you're recommending me to put something in 2%, why are you? And of course, the answer is because we don't know how much longer that 12% is going to be up. It's not a sustainable long-term return. So let's rebalance and reposition the portfolio back to the target mix. Remember, we did all that homework. Remember, you said this is how much risk you want to be taking on. Remember, you said this is your goal return. Okay, we need to rebalance back to that. We need to fight the urge to fall in love with our best performing investments and fall out of favor with our poorer performing investments. So rebalancing enforces a discipline that's critically important to be a successful investor. And that's one of the main reasons we should be rebalancing, is to keep that portfolio in line. The second reason is rebalancing allows us to theoretically sell high and buy low, which is a basic tenet of any successful investor over time. Is you're leveraging off the anomalies in the market. And again, presuming it's high quality investments, if some of your portfolio is on sale, you want to take money from something that's expensive right now, pull some money from that and buy something that's on sale. And if it's high quality, it's going to appreciate over time, right? So it enforces that wonderful discipline of buying back into assets at the right time. So we find that with services that we use when we build portfolios that have built-in rebalancing, then that discipline happens automatically. Right. So every month we have portfolios being rebalanced in response to market conditions. Now, do we have clients running into our office when the market's down to add back to assets that are priced at a discount? No. Most advisors don't have clients rushing to the front door with checks to add back to the portfolio because the bargains are on. We do that in almost every area of our life, with the exception of investments. We view it apocalyptic. It's an apocalyptic event. We want to move back to GICs or guarantees, when in fact, what we should be doing with some of our portfolio is buying back in and taking advantage of those anomalies, because that's how you're going to make money in the markets. You have to be a little bit contrarian and fight the urge to do what most people do during times of market volatility, which is run in the opposite direction, which is not what you should do. So we know that human nature is the way it is. And so one of the ways you can fight against that is put systematic rebalancing strategies in the portfolio where they just happen automatically. And I don't have to ask the client, can we do this? It just gets done.
Yeah, that's fascinating. Was there anything else you wanted to kind of cover off with these, or?
No, I think those are the main points in terms of our agenda today. What I would end with, Josh, is that, again, we'll encourage people to take a look at the show notes. For those of you that are within 5 years of retirement, we have a complimentary retirement forecast we make available to you. And we also have some resources, complimentary resources on different aspects of retirement investing, retirement cash flow planning, as an example. So be sure to check those resources in the show notes and make sure you subscribe if you're not already a subscriber to our channel.
Right on. Well, thank you everyone for listening. We'll be back probably about 2 weeks with another episode. And stay tuned. Thanks, Shaun, for doing this.
You're most welcome. Thanks, Joshua.